The question of the week is, how do buyers win in this challenging 2001 market? Hold on. Thank you so much for tuning in. This is MJTV, not HDTV, because we tell it like it really works, not in half an hour, under $1. So what we're going to talk about today is how do buyers win in this challenging market? It's really tough for buyers, but the good news is it's softening out a little bit. So before we go there, a couple of things. I'd love for you to just sign up below so I can keep in touch with you, let you know what's coming up next, and then you tell me what you would like to see, who you'd like to hear from. If you have comments, love to hear those too. So this week we're talking about how do buyers win in this challenging market. And there are two parts to that. One is the real estate agent working with you, and one is the lender. So today we'll have Shaun Higgins from Cross Country Mortgage, how he counsels buyers to prepare themselves when they dive in this market. And it is still a good market to buy. Before we go there, let's hop on my virtual tour bus because I want to show you a home that I saw in the Midwest Home Luxury Tour. So if we can hop on right here, here we go. We're going to visit Trestle Homes in South Minneapolis. Are you on the bus? Okay, so first of all, we have this beautiful, very modern, minimalist, but with mid-century tones home. And it has surprises inside. Usually you see one or two rooms that are kind of wow. This one has several. This is the dining room, living room. And you can see over on the left side, there's an indoor-outdoor living room as well. This is a breakfast nook and a beautiful big bell-looking lighting. Kitchen, very sleek, very modern. And you can see the slat is it's like a partially open wall. So it gives you an open floor plan, but with the illusion of a little privacy. Here we have, this looks very mid-century, very California. As you can see, this long wall with stone inside, outside. And oh my gosh, right here in this photo, we look like a normal bedroom. But what you're not seeing, what you'll see right here, is a walkout patio onto your own garden, and it's that second level is entirely a garden. Lovely master bath, again, very modern looking, sleek, soaking tub, separate shower, second bedroom upstairs. Can be a guest bedroom, a flex bedroom. It can be an office. You can see details. This is the main floor bath with beautiful tile behind it, like a granite tile. This is the outdoor living room, an extension of that nice big slab, dramatic black streak through. Again, the outdoor dining area, looking out over the backyard. And a side view, here you can see it's a totally see-through on the living room, front to back. Very modern for Minnesota, very livable. Again, it's by Peter Kane, a very modern architect who built his own home. So now let's go to how do buyers win in this challenging 2021 market with Shaun Higgins of Cross Country Mortgage. How do you prepare? What do you need to know? And most importantly, how do you win the house that you love? How buyers can win in the 2021 real estate market. Today we're talking to Shaun Higgins of Cross Country Mortgage, and Shaun has a ton of experience. How long have you been doing this?
Too long. Just over 20.
Over 20 years. Yep. So buyers are afraid right now, and justifiably so. This has been a very rough market. And there's all kinds of sort of quasi-fuzzy information out there. One is, I'll wait till next year when we have a market crash. And I don't think we're seeing it, but we're going to talk about it. So, Shaun, would you tell us, what are you seeing in the market right this minute?
Right this minute, I would say that we have seen a little bit of cooling down.
Yep.
It's crazy when we talk about cooling down though, because we're getting away from, maybe something in the teens for offers on the listings that our buyers are going in, like 15, 16 offers. I'd say it's got down to maybe 5 to 8 on a lot of these for that competitive market and prices. So that it's definitely came down a lot, which is for that competitiveness, which is gave a lot of people an opportunity that maybe felt pushed out earlier this year to kind of get back into things and give a swing at it.
Okay, terrific. Well, what I'm seeing, say pretty much the same thing, but buyers need to know there are some homes that linger on the market.
Mm-hmm.
So rather than chasing every new listings, we're going to be up against or heard, take a look at some things that have been hanging out there for a little bit. Some people, their talk, everybody's saying, oh, there's going to be a crash, a foreclosure crash. We're going to hit with a tsunami of foreclosures. What are you seeing? What are your thoughts on that you can share?
I disagree. I definitely could be wrong, but I do disagree. You and I both lived through that market, from 2000, I guess really started in 2005 till we got till last probably 2012. But the factors that are involved now are just completely different. I mean, then, this was kind of something that came at people overnight, and the loan products that were out there were dangerous.
Garbage.
They were garbage. They shouldn't have been out there. Overfinanced for the payment, overfinanced for lack of collateral for down payments. So when the market did shift dramatically kind of overnight, people are left in homes with little to no equity, which gave you very few options besides a short sale scenario or a foreclosure. Now, that is not the case. We have buyers or homeowners sitting in properties with not only a large amount of equity, but some with the largest amount of equity they've ever had in a home, since they've been a homeowner.
Well, one thing about during the recession or before the recession, in the boom, people would buy, and they would buy with a certain down payment, and then they would refinance every drop that they could squeeze out of it.
Exactly, and there is a really good stat that talks about that. So, everybody's seen The Big Short, or anybody that's in real estate or mortgage talks about The Big Short, and I love the mortgage guy in there. He represents us very well. But
He's out of business.
Yeah, he's on to his next.
He's in jail.
I hope. But the CoreLogic had and also Fannie and Freddie Mac did a kind of a study and looked
Tell
at
people who CoreLogic is.
CoreLogic.
What
Well,
do
you
stand?
kind of know more than me.
I know, but
CoreLogic obviously is just this huge database that collects data in regards to real estate and
they
gives you
provide the MLS across the country with
MLS,
data.
which MLS is where the homes are listed for sale for agents to research and show. But that data, what it showed is if you looked at all the people that purchased from like 1998 until, let's say, I think it was 2005 or 2006 when the market started to change with the mortgage crisis, and everybody talked about these bad loans and all these things that are going on with that, which is 100% true. The factor that doesn't get calculated into that is if these buyers kept the original loan balance that they looked to buy the house, none of them went upside down equity. So what that means is if I bought a house in 1999 through 2006 and I bought it for, let's just say, $300,000, and I didn't do any refinancing to borrow more money on that existing property, that natural appreciation from 98 to 2006 would have been completely fine. The issue was people were using their house like a bank, and when the appreciation was going up so much, the house that I bought for $300 5 years from now owed $400 on it.
Right. There was a theme out there that your house is an ATM.
Yep.
So if you want to go on vacation, if you want a boat, if you want more toys, all of which have zero value.
Yeah, and they depreciate.
Right. So then you're left with a higher balance, and the market is going down. That was the danger of it.
Yep. So really, that was the biggest thing, on top of obviously people being in loan products that not only did they not have much skin in the game from a collateral standpoint, but a lot of people were in what were called 228 loans, which means they were locked for 2 years, and they became adjustable rates for the next 28 years of the mortgage. Well, the margins on those were insane. So if I started at 6.5%, after those 2 years, your rate was going to automatically, no matter what was going on with the market, raise by 2 or 3%.
Actually, I had a client, and he had an adjustable. It's called an ARM. I'm not sure what that stands for, but anyway, it means adjustable rate
Mortgage.
Yep.
But
okay.
you nailed it.
His adjusted $1,000
For
from his pay, and 2 jobs he couldn't do anymore, and we had to do insurance.
Yeah, and that's the predatory lending part. And not only that, the part that's even more disgusting on those programs is they had 3-year prepayment penalties on them. So that means if I went in the fixed period of 24 months and it became adjustable,
wow!
if I did refinance before that 3rd year was up,
You got hit again.
6% prepayment
Ouch.
penalty on the existing balance of the mortgage.
Okay, so fast forward, we are not in foreclosure land.
Not right now, and I don't see that happening anytime soon.
So most people, even people who bought in the last 3 years, should have good equity.
Yes.
Okay.
Very good.
Terrific. Okay, so fast forward. That's past, but it's a little history so you know where we are. Gives us a level walking. Where are we now, and what should buyers do to prepare for this market?
The first thing I would say to prepare for this market is to be mentally and financially prepared. And you'd say mentally, what's that look like?
Sharpen your swords?
Well, like the thing is, you got to kind of know you're going to battle. I mean, right now, obviously, you got to have that intestinal fortitude to know that, just like anything else that's competitive at time to purchase, right now you just got to know your first or 2 or 3 shots, maybe 5 or 6 aren't going to go. But this is where I think the timing thing is huge too. If you have any inclination of purchasing, even within the next 6 to 12 months, getting pre-approved and get your financing in order now, there's never too early time to do that. The reason I say that is because we have to kind of put together different contingency plans for you in regards to being in a market where potentially you're going to have to offer over list price, cover appraisal gaps between what you offer and what the home appraises for, and potentially, it's not something we like to do, but potentially, be able to purchase homes with non-appraisal contingencies and not doing inspections, which we're not a fan of, but either way, if we set ourselves up to know what those potential costs are, the more information we can have, the more scenarios we can put together for you before you actually start looking for a house is going to give you a better shot to get in there.
And I think one of the pitfalls for people is they get really excited about every new listing that comes on.
Right.
And what happens?
Well, and this is why I work with the agent a lot, especially if we're working with first-time homebuyers with minimum down payments or down payment assistance, okay? And then what we do, obviously, Mary Jo, is we want to be very strategic in educating the homeowners. When those MLS listings come up, anything that's from day 1 to day 7, we're not even going to put on our radar. It has to get past that week of being listed to know where our type of buyers in that situation have a shot, right?
That's right.
For them to go look at a house that's been on the market or coming on for 1 or 2 days with 3% or down payment assistance, there's absolutely no shot, So,
okay, talk about closing costs. Number one, not everybody understands closing costs up front. And what are you seeing happening with negotiating with closing costs?
Well, negotiating with sellers is non-existent unless we're rolling that into the purchase price. But again, right, they're not going to, it can't be a zero-sum game, right? If we are asking for the seller to contribute towards our buyer's closing cost, then their net proceeds better equal the amount they're giving, right? So if they want $5,000, you're paying a $5,000 higher price, right? We have to figure out how to do that. The big thing about cash to close that I think gets missed on a lot of first-time home buyers is the down payment or cash to close obligation. So they're looking at it like, hey, do I qualify for this first-time home buyers program with as low as a 3% down payment? It's like, yes, you do. But let's talk about what everything that's included. Okay, that 3%.
Oh, absolutely.
It's just your down payment percentage of the purchase price. But then we have our closing cost and our prepaid tax and insurance.
And buyers don't always understand closing costs. Well, let's talk about closing costs for a second, because I used to get approval letters saying that the buyer is approved for X amount of dollar, expecting that the seller will pay anywhere between 3 and 5% in closing costs.
Okay.
Closing costs are what it costs to do the loan. So explain to the buyers what they need to know about that.
Sure. So like on our pre-approvals that we send out, we have highlights. So we have pre-approval highlights. So basically what we're talking about is what the buyer's approved for purchase price, and that's cuts us down to a payment they're approved for, what their cash to close goals are, and also we'll put on there's a spot that says, do they need or not need seller pay closing costs? And majority of people now we have to put, we have to pre-approve them so they do not need seller pay closing costs because that happening is going to be slim to none.
Okay, so the buyer who has down payment assistance and they need closing costs, what happens there?
Well, with down payment assistance, that's a little bit unique because with down payment assistance, you can actually get money for the down payment, plus you can borrow some to cover the closing costs and prepaids as well.
Okay.
So that assistance you can get can cover 3 different categories.
Okay.
So that's kind of a a la carte type deal.
Okay. So, but sellers are not paying buyer concessions, right?
I can't even remember. Like, it seems like a completely different planet from when we used to do that. But in a normal real estate world, for sure,
we would negotiate.
Yeah, we would negotiate that, and we'd navigate it the same way we talked about before in regards to netting it out. So, for example, for a first-time homebuyer, paying a $5,000 higher purchase price over 30 years is way more feasible than them coming up an extra $5,000 and having a $33 a month payment, right? So, to the seller, the $5,000 is the same. The net proceeds they get to them is the same.
Because it happens at the same time.
Right.
There's no long term. For the buyer, there is a long term.
Buyer, there is. We can spread that extra $5,000 or $10,000 amount out over 30 years. to make it feasible for them.
So are you seeing buyers being conservative with what they're buying, or are they going to the limit? Where are they, what's going on?
Conservative sounds like a 4-letter word right now. And no, I mean, honestly, what they're coming to us and the agents and saying is like, what do you think it's going to take to get these
Okay.
deals done? And that's where you have to have, the punch in the face conversation. I think it's even harder for you guys because I can tell them what it is. They're going to come back to us and go, guys, listen, we think we need to go here to get this done. And then we talk about the payment and the cash close for them, which that's always easy. But for me, for you guys having that fiduciary responsibility, especially with a first-time homebuyer, I'm sure that's very difficult to go, hey, I want to protect you guys in this transaction, but at the same time, you're hiring me to make sure I educate you and give you the information you need to put you in the best position possible to get accepted.
Right.
So we kind of blend those two things together, and then we also have to have a spot where we have to help them know how to say no as well.
That's super important. When is it worth it? When is it not? There was a little house that I showed last year. It was 673 square feet, and they were asking 205. There were 15 offers on it, 673. It was really, really small. So I told my buyer we need to walk. It went 20,000 over list for a tiny house. It wasn't worth it for her.
Right. I think that's where you find the value in an agent. When I'm edifying an agent I talk to a client, I let them know the biggest thing that we see about the best agents we work with is they're going to talk about more things than they talk them into. To me, that's a great agent. So.
I've had to drag buyers out, say, oh, but it's so cute. And I go, no, I see $50,000 in repairs. Excuse me. Come on, just get in the car.
Yeah. No, we're there to protect them from themselves. That's kind of what we're there to do.
Right. So what is the information you need? What kind of a down payment should they be looking to save?
It's it's so broad based on everybody's particular situation, but that's kind of where we get into that timing thing is where get in and get the pre-approval process initiated as quick as you can so we can give you the feedback on those things, and also we can set up what we call those no stops. Those no stops is basically saying, hey guys, based on your situation here, if we get to a position where the payment gets to X, it's a no when it goes over. We get to a position where your cash to close obligation is going to be here, we know we're at that no place, right? When it comes to no, we're not moving forward.
So they should know and not commit to more than they can actually do.
Right. And we can do that, and we can walk them through there's many ways to kind of skin the cat on these. And really, the earlier we can start digesting that information for them and having a chance to review it, the more comfortable it is. I always say my number one goal with people that are purchasing their home for the first time or the second time, honestly, is to manage their anxiety of the situation. If we can get the finance piece to a position where they have a good idea where everything sits before they go with Mary Jo to look at houses, the more enjoyable experience can be for everybody, and it lowers that anxiety.
Absolutely. I did have a client, and she was bent out over every offer, and they were writing good offers. It was just that the market was so competitive. It became hyper emotional to her, and she had basically 6 months to find a house.
Yeah.
So, it didn't work out very well for her, and it was just tough if somebody is so emotionally involved in every house they see.
And that's our Monday mornings, right?
Yes.
That's been our Monday mornings for the last 24, 27 months. It is kind of, we are psychologists on the side,
Not on the side. I had a shrink call me for advice.
I need to be going to the shrink more often. I think we all should. I think it'd help everybody.
No, it stressed them out.
They were like, let me refer you to someone else that might be a better fit.
Emergency shrinking,
yeah.
Great. Can you talk a little bit about appraisal gap or appraisal waiver? First of all, what is an appraisal waiver and who qualifies for that?
That is a great question. I'm glad you brought that one up. So appraisal waiver is basically when we submit your particular application, and once we have a specific property you're going to make an offer on or get accepted, we run it through what's called an automated underwriting system, which is DU or LP,
Right.
So Fannie Mae or Freddie Mac.
So like a pre-approved with a buyer conditions.
Yes.
Right.
And the thing that's frustrating for people is there's really no exact checklist of what's going to help you get an appraisal waiver. So what it's going to do is it's going to take a risk assessment of the loan based on three main things. It's going to take a look at what the down payment is, what the credit score of the borrower is, what their debt to income ratio is, and also they have to have enough data on that specific home. So for example, I've run into this, 3 or 4 times where, a borrower's putting 30 to 35% down, excellent credit, good job history, everything across the board, all boxes are checked, and we can't get a waiver, and we don't know why. Well, the reality is that even though all those boxes are checked, this particular home has not been sold in over 11 to 12 years.
So they don't have updated data?
They have no information on it. They haven't seen it sold in the last 10 years. So based on all these things that happened here correctly, now it's just coming directly to the property. That system can't pick up enough data from sales on that particular property, and it won't go.
Okay, I have had 2 occasions where we put in offers, and without saying anything or doing anything, the bank did waive an appraisal. They did automated appraisals.
And you guys weren't notified? They didn't notify the agents or the buyers or anything?
Well, only towards the end, they said we'd waive the appraisal.
That's weird. Yeah, I don't
Okay.
know. I don't know. Because you'd think that people would be freaking out going, when's this appraisal getting ordered? Has it been done? What's the value? And all that type of stuff. And then I don't know, they're like,
Yeah.
oh,
Both of them had 20% down.
yeah.
Both of them had really good credit. Houses were under 300,000.
Yep. Your biggest candidate for getting an appraisal waiver is good credit, 20% down, in a property that you're buying that has been sold in the last 3 to 5 years.
Okay.
Because they have the data there. So
Right.
that's your wheelhouse.
What the value was.
You
Right.
can get appraisal waivers for less than 20%. I think we've had at least 4 in the last 2 years with less than a 20% down, we still get a waiver on, which was 15%.
Wow, that is a surprise.
Yep.
Really. So then, how about should buyers have an emergency fund or backup?
In this market, you at least have to have the conversation, on what and if, what we can do.
Okay, so let's say we're facing something where somebody wants to pay the gap if there is an appraisal shortage. Can their parents or family help them with funds to do that?
Yes. Yep.
Okay.
And depending on the program, we have to be very careful on who's giving that money.
Okay.
FHA, obviously, which seems like a dinosaur now because people just aren't getting their offers accepted at FHA. But with conventional stuff, that does have to be a blood relative. That can't be a friend. It's even with an aunt and uncle and stuff, I mean,
Okay.
it has to be a brother, sister, mom,
First
dad.
bloodline.
First bloodline for conventional
Okay.
financing.
Okay, terrific. So what do you see happening in the next few months in the market?
I mean, I really don't see it slowing down that much more. I feel a resurgence of a lot of people coming back around that maybe gave up the process, earlier this summer because
Sure.
of the buyer fatigue. And that's our job, I think. It's our job to keep reaching out to these people and say, hey guys, there's opportunities now. We're seeing things slow down a little bit. It's time to get back out there if you have it in you and at least see what we can get done. And I think that'll be a really big deal to keep things fired up through the end of the year.
Well, usually every year the spring is crazy.
Yep.
Right? Every year. And then normally in a normal year, what used to be a normal year, but post-COVID, we don't know what that is anymore. The market would flatten out in the summer and come back in the fall.
Right.
But last year it went zoom all the way to election day, and then it stopped and started again the 1st of January.
Yes.
So we're not working with the normal rhythms of the market. We just don't know until it's happened what's going to happen.
Totally, and I don't know about you, but I'm sure you have a lot of similarities in this, but you got so used to the routine of following what the market looked like, right? And you had times, what we call the Super Bowl rule, remember? We had from after Christmas to the
Right,
Super
get
Bowl.
ready.
That was your time to restructure.
That's the spring market.
Yeah, restructure, get everything put back together so you're ready to go. Now it's pretty much everything's learning on the fly, right? Because
Yes.
the volume is just continuing to go up. It's going this way, it's going this way. We're constantly on our side getting the questions in regard to interest rates. And those are questions we can't answer with any kind of-
But I heard that the Fed was going to hold the interest rates until 2022.
Yeah, I mean, based on what they're looking to do for purchasing mortgage-backed securities, we should. I mean, all the factors that we're typically looking at to follow interest rates, inflation and the yield on the 10-year Treasury note,
Okay?
have kind of went out the window. When the yield goes down on the 10-year, interest rates should lower. When the yield goes up on the 10-year Treasury, that's go. Has been the fear and inflation is the enemy of interest rates, right? Well, with all this money that's being pumped in, everybody I have so many clients will tell me their stories, especially, baby boomers like, wow, I see the savings loan crisis from the 1980s coming again, just see it, that inflation thing's coming. But the reality is, again,
It was a different world.
completely different world. The market, the way it's set up now with the global market, it's completely different. So, inflation is something that's going to plug in at some point, but I mean, normalized rates, we should be at least in the fours, mid fours to be normal. So we'll see what happens.
Right, but it's almost as though, like, from 2 years ago forward, we had no past because it's irrelevant whatever happened before.
Yeah.
We're in new rules, a new level. This is a new market, and this is where we're going. We're just going forward on this.
Yeah. Yeah, I mean, it's a conversation we have constantly, but I mean, really, right now, if you look at it, this has shown you really the value of real estate. I mean, and being invested in it and owning it for your personal retirement wealth. I mean, it's been consistent. There's only so much earth.
Oh, and not only that,
on.
I sold a couple, a little house in Richfield 4 years ago for $150,000, and last spring, anyway, 4 years later, we sold it for $285,000.
Yeah.
So they walked away with more than $100,000 in equity for living in the house. They did not make major improvements in it. I don't expect it to keep accelerating at that rate, but it is a good long-term investment if you take care of the house.
100%. And the thing is, again, when you're looking at that scenario, if that appreciation, that goes up there, it's really what happens with it and where it takes you in your life, right? Because if we're getting to a situation where in our mid-40s, we have $200,000 equity, but we're selling that house to purchase something larger, right? And put $200,000 on something else I have to pay on for another 40 years, then it kind of defeats the purpose, right? But if we're looking at something where we can get something that's free and clear and used as a retirement vehicle, then it all makes sense. So really, everybody's situation is a little bit different. So you just kind of figure out which one fits best for you, and hopefully you stick to it.
Shaun, thank you so much.
Thank you.
I hope this is really clear. Can we come back and talk about baby boomers and strategies for
Let's
them?
do it.
Okay.
Let's do it.
We'll stay tuned for that. Thank you, Shaun. Where can people get in touch with you?
You can reach me here at our office at 952-567-2781, or the email address is Shaun, S-H-A-U, as in Utah, Higgins at myccmortgage.com.
Thank you, Shaun.
Thanks, Mary Jo.
Thank you so much for watching. I always appreciate your comments. Let me know what you like. Let me know what you would see. So thank you again for coming. Don't forget to sign up. Just do it for me. Love to hear from you, and stay tuned next week. We'll see you then.